You know that old joke that there's a Starbucks on every corner in the United States? And that Dunkin Donuts slogan, America runs on Dunkin'? Well, there's a Canadian coffee chain that makes those look like quaint little neighborhood cafes. Meet Tim Hortons, Canada's one-stop shop for coffee, breakfast, lunch, and donuts. In 2018, it supplied over 60% of the revenue of its parent company, Restaurant Brands International, which also owns Burger King and Popeyes. More importantly, it's been a company darling among Canadians.
The DNA of the brand is Canadiana. It's hockey, it's, oh, we're polite. It's all the stereotypes that Canadians, love that they have. It's every bit as Canadian, and even more so than Coca-Cola is American.
In 2015, the last year that Tim Hortons made its store count publicly available, there was one Tim Hortons location for every 9,800 Canadians. These are the same figures for Dunkin' and Starbucks in the United States. But this success is quickly becoming a problem.
They have definitely reached a saturation point within Canada.
The company needs to expand elsewhere, and the US has long been a target. But they've struggled here for decades, which raises the question, why can't this Canadian icon win over its southern neighbors? The first ever Tim Hortons opened in 1964, right here. And the first successful location in the US opened just across this border 20 years later. A few years earlier, Tim Hortons opened 2 locations in these 2 Florida beach towns, hoping that vacationing Canadians would both support the business and bring in Americans. But these struggled because of production issues and because Floridians lacked the brand awareness that Americans closer to the Canadian border have.
Bottom line is this: the closer the geographical proximity of an American city to the Canadian border, the better off Tim Hortons does.
Both of the Florida Tims closed in 1995, and the brand has stuck close to the border ever since. The company expanded rapidly across these states using a franchise model in the 1990s and listed on the U.S. stock market in 2006.
Tim Hortons kind of just jumped into the franchise, opened up a couple hundred stores in the U.S. fairly quickly.
Using data from their subsequent public filings, we can see that 98% of Tim's locations in the U.S. were in just these 8 states.
Why? It's both recognition and recall. The closer you are to the Canadian border, the theory would say that you are going to be more likely to cross the Canadian border for a weekend shopping. There's a Tim Hortons on every block. It's not bad stuff. They like it. Go back across the border, and if Tim Hortons is there, they'll more likely be a consumer.
But even these border states couldn't cushion Tim Hortons against their biggest problem in the U.S., market saturation.
If you're the 15th company that's entering an American market offering coffee and donuts, you're so far back in terms of mind share, and Tim Hortons does not have huge dollars in comparison to some of the other competitors or the entrenched regional players that may be there, or national players like Starbucks, for example.
Anyone can name their nearest Starbucks or maybe their nearest Dunkin Donuts. So in the US, it's facing a lot of competition.
For Canadians, Tim Hortons is a go-to spot for many food items: hot and cold coffee drinks, breakfast sandwiches, lunch wraps and soups, fruit smoothies, and of course, donuts. But Americans have many other options. Dunkin' and Starbucks, of course, but also Panera Bread, Jamba Juice, McDonald's, or one of the other estimated 58,000 coffee and snack shops in the US. And these all have far better brand recognition among Americans.
Humans are creatures of habit. If you have an option between a Starbucks, Dunkin Donuts, and a Tim Hortons, you're probably going to go to Dunkin Donuts because you know that product, you know what your order is, it's familiar.
In 2010, Tim Hortons closed 36 locations throughout New England after their poor performance cost the business $4.4 million that year. This included a complete retreat from Connecticut, Rhode Island, and Massachusetts. Burger King bought Tim Hortons in 2014 for $11 billion. And the combined company, Restaurant Brands International, established its headquarters in Toronto. Analysts told CNBC as part of the agreement to locate the company in Canada, the Tim Hortons segment promised to continue expanding in the U.S.
They had to prove that they were going to expand internationally, especially into the US, and get the brand to grow further and not just be concentrated and saturated within Canada.
But in 2015, the very next year, RBI closed 234 locations in the US, telling CNBC in an emailed statement that the closures were a part of building a foundation for future growth in the United States.
Starting in 2016, they've stopped breaking out the Tim Hortons growth specifically in the US as focused, just because of the heat they've been getting in terms of performance of Tim Hortons in the United States.
RBI did not respond to CNBC's request for comments or an interview, so no word on exactly what their plan is. But analysts point to a few trends or strategies the brand could use going forward, like premium coffee and donut options or healthier breakfast sandwiches. RBI has been at the forefront of the plant-based meal trend, including Impossible Burgers at Burger King and Beyond Meat sausages at Tim Hortons in 2019. It also struck a deal in July 2019 to test just brand plant-based eggs at some Canadian Tim Hortons locations. But some think RBI is waiting too long to launch these items in the US.
Something they should consider doing is launching the products that they launch in Canada at the same time in the US, because it's not like they don't have the infrastructure.
And some wonder whether RBI should look beyond the US altogether.
Outside of the US, Tim Hortons is growing quite popular, right? So they have introduced stores in Mexico. I think it's the Philippines they just started launching in as well. So anywhere where Starbucks and or Dunkin hasn't completely taken over, I think might actually be a better fit for them.
I know the US is the big gem for any company that wants to create an international brand or grow, biggest consumer market in the world, but it's also the most competitive, and that's a very tough market.